Hello everyone. I will. It's 1:30 Central Time, and it is almost time for Fed to make some announcement. Uh, so basically, we got the central bank today raised rate at 3/4 of a point, which is 0.75% of the point hike, and it's the affect the market. You can see there's alright, let's go to the chart. You can see there's like last three sessions we were like going down, but today the market is performing very well because ahead of the Fed.
Good afternoon.
Okay, he start talking now.
My colleagues and I are strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down to our 2% goal if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight and inflation is much too high. Against this backdrop, today the FOMC raised its policy interest rate by 3/4 of a percentage point and anticipates that ongoing increases in the target range for the federal funds rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet. And I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. Recent indicators of spending and production have softened. Growth in consumer spending has slowed significantly, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened, in part reflecting higher mortgage rates. And after a strong increase in the first quarter, business fixed investment also looks to have declined in the second quarter. Despite these developments, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 375,000 jobs per month.
Take a look at some
down from the average pace seen earlier in the year,
okay?
but still robust.
So let's go to SPY and see.
Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics.
So in the 5 minute,
labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. Overall, the continued strength of the labor market suggests that underlying aggregate demand remains solid. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in May, total PCE prices rose 6.3%, excluding the volatile food and energy categories. Core PCE prices rose 4.7%. In June, the 12-month change in the Consumer Price Index came in above expectations at 9.1%, and the change in the core CPI was 5.9%. Notwithstanding the recent slowdown in overall economic activity, aggregate demand appears to remain strong. Supply constraints have been larger and longer lasting than anticipated, and price pressures are evident across a broad range of goods and services. Although prices for some commodities have turned down recently, the earlier surge in prices of crude oil and other commodities that resulted from Russia's war on Ukraine has boosted prices for gasoline and food, creating additional upward pressure on inflation. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship especially on those least able to meet the higher costs of essentials like
So we
food,
don't have like
housing, and
a
transportation.
significant up and down.
We are highly attentive to the risks high inflation
look like it's
poses to
going
both
up.
sides of our mandate.
Not really.
We're strongly
making-
committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, bringing the target range to 2.25 to 2.5%. And we're continuing the process of significantly reducing the size of our balance sheet,
Okay, now
which
it's
plays
going
an
up.
important
Now
role
it's going up.
in firming the stance of monetary
Okay,
policy.
now we got.
Over coming
here.
months, we will be looking for
Why you
compelling
talking?
evidence that inflation is moving down, consistent with inflation
Okay,
returning
now
to
it's going
2%.
up.
We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and evolving outlook for the economy. Today's increase is in the target range is the second 75 basis point increase
wow.
in as many meetings.
So they kind of.
While another unusually large increase could be appropriate at our next meeting, that is a decision that will depend on the data we get between now and then. We will continue to make our decisions meeting by meeting and communicate our thinking
So-
as clearly as possible.
It's going up.
As the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation.
Right, I'm kind of waiting
Our
on
overarching focus
Roblox
is
break
using our
to
tools
this
to bring
level
demand
and
into
hold
better
above
balance with
it.
supply in order to bring inflation back down to our 2%
They
goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways.
He is
Inflation
reading
has
his
obviously
script.
surprised to the upside over the past year, and
Okay,
further
so
surprises
the
could be
goal
in
with
store.
inflation will be about 2%.
We therefore will need to be nimble in
Let's
responding
see
to
if we
incoming
can
data and the evolving
make
outlook.
it
And
any
we will
like
strive to
effort
avoid
to
adding uncertainty in what is
like,
already an extraordinarily
inflation
challenging
is
and
going
uncertain
down.
time. We
I
are
mean-
highly attentive to inflation risks and determined to take the measures necessary to return inflation to our 2% longer run goal. This
The
process
option
is
is
likely to
looking good.
involve a period of below-trend economic growth and some softening in labor market conditions. But such outcomes are likely necessary to restore price stability and to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Hi, Chair Powell. Thanks for taking our questions. Rachel Siegel from the Washington Post. I'm wondering if you can walk us through your thinking around the decision not to go for a full percentage point increase. We saw a ramp up after the May CPI report came in hotter than usual, and then obviously the June figure did too. Was there any discussion of a stronger hike at this meeting? Yeah, thank you.
Sure. So we did judge that a 75 basis point increase was the right magnitude in light of the data and in the context of the ongoing increases in the policy rate that we've been making. I'd say that we wouldn't hesitate to make an even larger move than we did today if the committee were to conclude that were appropriate. That was not the case
the
at this
interest
meeting. There
rates
was very
will
broad
going
support
up.
for
So
the move that we made.
the mortgage.
You
so
mentioned
the
the
real
June
estate.
meeting. We had
the
said many
mortgage will
times
be affected.
that we were prepared to move aggressively,
So
more
let's
aggressively if inflation
see
continued to
how the
disappoint.
housings will be
And
affected.
that's why we did move to a more aggressive pace at the June meeting, as we said we would do. At this meeting, we continued at that more
So
aggressive
the rate
pace
is going
as
up,
inflation
then
has
the
continued
mortgage
to
rate will
disappoint
going
in the
up.
form of the June CPI rate.
Borrowing rate will going up.
Thank you so much for taking our questions. Colby Smith with the Financial Times. As the committee considers the policy path forward, how will it weigh the expected decline in headline inflation, which might come as a result of the drop in commodity prices, against the fact that we are likely to see some persistence in core readings in particular? And given that potential tension and signs of any kind of activity weakening here, how has the committee's thinking changed on how far into restrictive territory rates might need to go?
So, I guess I'd start by saying we've been saying we would move expeditiously to get to the range of neutral, and I think we've done that now. We're at 225 to 2.5, and that's right in the range of what we think is neutral. So the question is, how are we thinking about the path forward? So one thing that hasn't changed is that it won't change is that our focus is going to continue to be on using our tools to bring demand back into better balance with supply in order to bring inflation back down. That'll continue to be our overarching focus. We also said that we expect ongoing rate hikes will be appropriate and that we'll make decisions meeting by meeting. So what are we going to be looking at? We'll be looking at the incoming data, as I mentioned, and that'll start with economic activity. Are we seeing the slowdown that we?
All right.
The slowdown in
So
economic
Roblox
activity,
is going up
that we think we need.
8.20% today.
There's some evidence that we are at
It
this
did
time.
break to
Of course,
that,
we'll be looking at labor market conditions, and
resistance
we'll be
point.
asking whether we see the
Let's keep
alignment
going
between
up
supply
now.
and demand getting better and getting closer. Of course, we'll be looking closely at inflation. You mentioned headline and core. Our mandate is for headline. Of course, it's not for core, but we look at core because core is actually a better indicator of headline and of all inflation going forward. So we'll be looking at both, and we'll be looking at them at those both really for what they're saying about the outlook rather than just simply for what they
SP
say.
500
But we'll
is
be
going
asking,
up.
do we see inflationary pressures declining? Do we see
For like
actual
2%.
readings of inflation coming down? So in light of all
So
that
the
data,
whole
the
market
question we'll
is
be
going
asking
up.
is whether the stance of policy we have is sufficiently restrictive to bring inflation back down to our 2% target. And it's also worth noting that these rate hikes have been large and they've come quickly, and it's likely that their full effect has not been felt by the economy. So there's probably some additional tightening, significant additional tightening in the pipeline. So where are we going with this? I think the committee broadly feels that we need to get policy to at least to a moderately restrictive level. And maybe the best data point for that would be what we wrote down in our SEP at the June meeting. So I think the median for the end of this year, the median
Okay,
would have
so
been
I
between
think
3.25 and 3.5.
What we're gonna do is,
And then people wrote
I
down
don't think this
50 basis
is
points
a really
higher than that
stable
for
market right now.
2023. So that's, even though
We
that's
just
now
had the Friday
6
action
weeks old,
that
I guess, that's
probably
the most
people
recent reading. Of course, we'll
making-
update that reading at the September.
And done. Basically, right now they just answered the press about the question that they had, but basically it's just the main focus for today. They just increasing raise for 0.75%. They try to fight inflation, but they're not really going full power for it. They say they're gonna do it slowly to have the inflation is going down, and maybe later on when the inflation is going to their target inflation will be 2% a year, which is right now last month it's like over 9%. So to bring it down to 2%, that is not an easy task to do. So and of course it's gonna affect the the housing markets right now. So basically we got the home sale fell about 20% in June versus 8 years ago because of the mortgage rate. And again they increasing the interest rate, so we will see some decreasing on pricing the home price. So somebody bought it at the really at the top of the market, the housing market, then they're gonna take a loss. If they sell it, they're gonna take a loss. But they don't sell it, it's like, they're just losing values on that house. Okay, I'm gonna go to let's see, go to Austin. Gonna see some housing markets going, what is going on right now. Switch the view. Okay. So housing market in Austin is pretty hot because of all the tech companies moving to Texas, especially like Austin area. So let's see some house like maybe a new one. This day we see there's some pricing cut. It's not a lot, but there's some cut right there. It's just going up too much, and it has to going down because the demanding is gonna be not as strong as last year. Last year is where the interest rate is so crazy. Okay, so they were like probably they do some remodeling for the house, and then they list for sale in June some months ago 434, and then they cut down for 10 grand, which is 2.3%. Yeah, it's not significant. I will take a little bit for the housing market going down a little bit. If you want to take a look at the market and if you want to buy a house, basically not right now, because with all the crazy stuff going on. So this house about 300, and it's worth cut 51,000. We're gonna take a look at the price and history. Have a lot of price changing. Okay, probably this people. Just were listing last year for 200. It's about 300. Then it up, it's price, it's gone down, up and down. I mean, this person is, I don't know. Oh, probably it's already sold. I'm not sure if it got sold or not. But it took down, it's up at its price, didn't got sale, so it went down. Probably the house is way too old, and no one, like people don't want to buy it, or something going on with it. I'm not sure, but we will see some price cutting across the nation. Alright, let's go back to our stock market. See what's going on right now. It's gonna be our main purpose. Wow, so SPY is going over 400. That's nice, man. And Roblox is going up. It break the supporting level right there, 41.95. Now let's go back to our trend. This is great. I will definitely, I own some Roblox there, and then usually I gonna take a look at the market and the condition. So if there is like 1, 2, 3 session is going up, then I will sell some option, because I own some shares, so this is really nice way for me to earn like extra income on the share I own. So there will be 2 days from now, and then my target price, I don't want my share, they took away up my share, so I would look for some option that is not gonna be happen, you know. So look at the delta right here, delta gamma terra, but I'm not really good at doing analyzing on the option. I just know that there is a percent it will hit into that target price. So it will be nice for me if I sell, for example, I own 100 share of Roblox and I sell the option for $40, $46, then I will basically got $14 for that. For 2 days, $14 plus I can keep my share. Could be nice strategy. If you holding a stock for a long term, that would be nice to selling option, selling call option. So for example, Friday, let's go back to July 29. So for example, July 29, Roblox is $45, and then I sell the call for 47. I will buy to close on that day. I will let the option to be expired because on that day the option call at 47 will be worthless, so I will be able to keep my share, so it won't be called away. And then if in another scenario, if the stock is going up to like $50 per share, then my share will be called away. For that 100 share will be called away, and I have to buy it back. So my strategy is I don't want to like my share took away from me, because I want to hold it for a long term. For short term gain, as they tax more for short term, hold for long term, tax rate lower. So there's some strategy to earn some extra money while you holding that investment. So basically you bought a house, it's gone up, gone down, but then you rent that house, so you make some passive income. Wow, so it's really nice today, and it will break into that level. I won't say it's not gonna be the same. Will be, let's see, when is the inflation data? Probably inflation data for July will be somewhere in mid-August, and then that will be have a really impact to the market, because what market is looking right now is the inflation rate. So if they cannot control the inflation rate, if the inflation rate is not going down, then it will be a red. It's going down, red market. But if the inflation rate is going down, for example, June is 9%, so July, if it's gone down to 8 or 7%, it will be a great signal for the market to going up. So today it is some reaction of the market to Fed decision. Yeah, there's some company, some corporation out there will be benefit from this market condition, but there's some other company out there will be affected by the decision. So let's take a look at the heat map. So the heat map showing us like the IT software is going up because they got beat up so bad. So Google is going up 8%, PayPal going up 12%, Shopify going up 11%, Amazon going up almost like 5%. It's bringing the whole market up, which is great. It's been a long time. The market is going down for many months now. This be really great for seeing green, Sometimes you just get used to the red market. when you see that green, like from here, the star going up, like from here, star going up the middle of July. It's bring joy to people, man. Like trader, like a pool trader like me. I like it when it's going up. So basically, our decision, yeah, it's not gonna go down anymore. We're just gonna see price reaction until like August 15th. I will take a look at it, see the report for the inflation. Then if someone wanna do aggressive investment back by that time, might be a good time to buy some stock and build up portfolio. Not today, not today. Just has to be slow, watching the markets, see the price reaction, and making sure you get in right on time. It's really the problem right now with Roblox. They have to be dealing with the earning upcoming, so it's gonna be a little bit risk. Not a little bit. There will be a risk to buy Roblox at this point. Gotta wait for the earning coming out. Gotta wait for the inflation before make really significant investment into the market or any like individual stock. Individual stock will be a little bit different for the overall market. So it's worked great for today, and let's see update maybe next week or so if I have time. Alright, thank you for watching.